So I'm going to give it just a minute, let everybody kind of join in, and then I will get going here. So again, this is Jordan Pence, and our company is Advisors Resource Company. And today, our plan is to discuss executive bonus plans. Pretty popular strategy, pretty easy to administer. There's some relatively large benefits. Throughout the summer, I'm going to do a few more in addition to this. I'll do a split dollar one, I'll probably do a premium finance one, and a couple of others in addition to that. But we're going to start with the basic here. This is, like I said, a very simple way to help primarily business owners save for retirement. You can use this for employees if you wanted to, but there might be some other strategies that could be a little bit more effective, like deferred compensation, which we actually will do another one of those later on in the summer. But anyways, enough talking here. I'm going to get this thing started. Again, my name is Jordan Pence. Our company is Advisors Resource Company, and this is a webinar on basically executive bonus plans. So let's get started. The topics we're going to cover here today is who's a fit, the Tax Cuts and Jobs Act. I'm not going to go into that much detail on that, just kind of high level. Overview of an executive bonus plan, also known as Section 162 bonus plan. Why use life insurance for this type of thing? It's going to include index options and like a historical analysis along with that. And then finally, I'm going to go over our presentation. I have a case study on that, so our presentation on that. But first things first, who is an ideal candidate for this? So ideal candidate, they own a business. Annual income is somewhere between 150 and 500,000. The reason I put an upper limit on this is because if somebody's making more than $500,000, there might be some other strategies that could probably benefit them more. Maybe have a little more tax savings, maybe have a little bit more effectiveness. Ages, I mean, this is basic life insurance. You could go younger than 30, but typically you're going to see at least 30-year-olds and up to 60. After 60, the participant or the insured in this case doesn't really have enough time to save. So, those are probably the most ideal candidates. I will add, if they're a business owner doing it for themselves, you're going to want to look at pass-through entities. So, S corps, LLCs, partnerships, things like that. If it's a C corp, tax as a C, or a corporation tax does whatever the wording is. But if it's a C corp, there's other strategies that we're going to cover later on that might be a better fit. You can reach out to me and we can discuss that. I'd be happy to talk about that. What might be a better option? So moving on from there, my thing will advance. Here we go. The Tax Cuts and Jobs Act. What were the changes? What was the impact on taxes? So this was signed into law 2017, end of 2017, came into effect 2018. And really it's the most significant tax cut since the 1986 Tax Reform Act. One thing to keep in mind with this is they're saying it's set to sunset in 2025. So we'll see. Hard to know what's going to happen, but at least for now, this is the law of the land. And, like most cases, I doubt it'll change through significantly. So what's relevant to this discussion is the 199A, the QBI, the qualified business income deduction. And really this gives you more tax advantages if you're an S corp or some sort of pass-through entity. So there's certain rules on the deduction. We don't really need to know about that now, but the whole reason I'm talking about this is if, as this is a business owner doing this as a business owner, it would be a huge mistake to account for the bonus into the policy as wages, because they could count it as like owner draws or a dividend, and they would still get the 199A deduction. So that's the only thing the only reason that I'm bringing up this is just simply how the accountant accounts for the contribution. So if they put it as like employee wages or anything like that, that's probably going to be excessively taxed. And if your CPA wants to do that, then your client should probably consider a new CPA. But anyways, that's kind of that part of it. That's not really a big thing, but you just should be aware of that. So if you get in front of a CPA and you're talking about this plan, they're going to ask, well, how do I book this? And if it's for the business owner, you're going to want to count it as owner draws, because it has the potential to qualify for 199A. So I'll get off my spiel with that. So if anybody has any questions, feel free to let me know. I'm trying to check the thing if anybody asks any questions in the Q&A, but anyways, executive bonus plan, section 162 bonus plans. What is the concept, the purpose, the process, and then how does it work, the bottom line? So the concept is really the executive bonus plan is an agreement between the employee and the owner. So really this is paying the employee, I'm sorry, the employee and the employer. So really this is an agreement where the employer is going to pay the employee a bonus, and that's either going to go into a life insurance policy that employee owns, or it's cash that's given to the employee, and then they use that to pay premiums on the policy. That's kind of semantics. Basically, it effectively becomes taxable income to the employee. So this is like the definition of executive bonus. In reality, if you're doing it for, well, I'll take a step back. If you're going to do this as an employee benefit, there's like no control over this unless you do a restrictive endorsement. But even with a restrictive endorsement, which just basically means that the employee has to get the employer's permission to access the cash values, you have some problems with potential deductibility of those payments into the policy. So this is going to talk, the rest of my presentation is going to talk like sort of the employer-employee relationship, but the reality of this is there are better plans if you're going to do this as an employee benefit that gives the employer, me, if I'm the business owner, more control over it. So I'm gonna go through this, but that kind of makes it a little bit more complicated. If I wouldn't recommend to a business owner to do an executive bonus for their employee unless, I can't really think of a good scenario where that would make sense, because you just don't have any control. You could do the restrictive endorsement that would protect the business owner a little bit, but it's not as good as like a deferred comp plan or something. Even a split dollar would be better. So that's just kind of one of those things that you might want to consider. So anyways, that's the concept. The purpose is really that it's an employee benefit that's going to reward specific employees or specific key employees, valuable employees, that sort of thing. So again, if you're just going to pay out a bonus, that's basically like paying out cash. So you lose control over it. What the employee gets is, well, bonus, as well as the life insurance policy, the cash value growth, et cetera, et cetera. So really if you look at the definition of Section 162 bonus, it's really a selective employee benefit where, you're giving the employee over and above their typical wages. The reality of it is that's probably not a very good idea in many cases. So anyways, process, and this is, like I said, by the book, the employer is going to write out the terms of the agreement. In a perfect world, they would do that. The employee owns a life insurance policy that they're the insured. In theory, their wife could be the insured. Anybody could really be the insured as long as they have an insurable interest. So that part doesn't necessarily matter. The employer, the business, is going to pay the annual premium. So that's a deduction. That's a cash bonus to the employee. They pay the premiums. The employer gets to deduct that bonus, assuming it meets reasonable compensation from IRS definitions. So the process is just listed here. The business gives the executive the bonus. They put it into the life insurance policy. There's some tax on that, so the IRS gets paid, and then later on, the executive gets retirement and death benefits. So the cash values belong to the employee. They can use it for whatever they choose, buy a car, supplement their retirement income. And if the employee dies too soon, they get the death benefit paid out to them, which is obviously tax-free, just like normal life insurance, just totally tax-free. So the bottom line is executive bonus arrangements are really a very simple way to reward valuable key employees on a selective basis. The big negative is if you're doing this for an employee, you have no control. I mean, you could, like I said, you could do a restrictive endorsement, but then you have the potential to lose your deductions and things like that. Now, the reality of it is, maybe if you get audited, or are they going to, find that out? I don't know. I've never had that situation pop up, but anyway, so you could do that. But moving on from there, why life insurance? Just really the advantages of your typical cash value life insurance plan. So customized, it's non-qualified benefit. The employee or even the business owner is the owner of the policy, so they have personal ownership. You have a choice in when you take out the money, so you could take it out before 59 and a half, after 59 and a half, you could take it out at, there's no age 72 RMDs. If you're doing an index product, cash values are protected from market fluctuations. There's the tax deferred growth, and then you can take the growth out with no tax consequences, assuming you take loans. And the income tax due, and this is our little twist on this, you don't necessarily have to do this, but income tax due can be paid using a loan or a withdrawal through the policy. So one thing I haven't mentioned is there's still taxes due on the contributions. Advantages of cash value life insurance I sort of just covered, but the only thing that it really doesn't have from me, the individual standpoint, is the tax deductibility of premium payments or contributions. Your values grow tax deferred, no contribution limits, no 10% penalty for withdrawals prior to 59 and a half. One thing that's not listed here from an employer standpoint is you can be selective in who you allow in this type of plan. So you could, choose whomever you want. Distributions aren't taxable. Death benefits income tax free. Values, at least in Texas, cash values are protected from creditors and litigation. I should mention that as well. The next important thing, these are the indexes that we like to choose. And so here's some index options. This is why indexing makes sense. I'm just going to go through the history. So I have Mark V, which is a low volatility index with a participation of 150% participation. I have NASDAQ 100 with a 0 floor, 9.5 cap. And then I would typically recommend the uncapped S&P with a spread of 6%. And if you look, I'll just point to the 20-year averages. Let's see if I can get a laser pointer out here. Here we go. If you look at the 20-year averages, the Mark V is almost 9%. That's pretty good. That was over basically the last 20 years. NASDAQ 100, you're looking at 6.9, still pretty good. I have the S&P 500. That uncapped is an average of 7.8 over the last 20 years. So, I mean, pretty good returns there. What I do is I take this a little bit one step further, and I think this is interesting. And I do, if you've been, which I know some of you have probably been to my other webinars, I do. You've probably seen this before, but I think it's so important to the product that it's good to talk about. So this is just the last 20 years. So we just talked about that. So I'm going to skip that. But here I have the best worst analysis, which I think is a fantastic analysis. So this is the best worst analysis of the NASDAQ 100. Worst 20-year period on the NASDAQ 100 with a 0 floor and 9.5 cap is 5.5. The median, which is basically the average, is 6.5, and the best is 7.6. So pretty good. Pretty good results with that. This is just the next 20 years of that. And then I have the Mark V, which is that uncapped strategy with 150% participation. This is with the 150% participation. Worst 20-year period was 6.6. The median, which actually is the average, is 7.8, and then the best is 9.2. And then finally, and then this is just the next 10 years. I couldn't fit it all on one page. And then I have the uncapped with a spread of 6%. These numbers are after the spread of 6%, but worst 20-year period is 4, average is 8. This is actually the median, but it's basically it is actually ironically equivalent to the average because it's a normal distribution. And then I have 11.5 as the best. So bottom line is you can see the benefits of indexing in these life insurance policies. You can get significant returns. All of these have a floor of 0. So due to market fluctuations, you can't lose anything. You have immediate liquidity as soon as you start getting surrender values. So there's a pretty large benefit to these types of policies. So executive benefit plan, just another overview. So we already looked at this. This actually comes from our presentation, which I'm going to share in a minute. But like I said earlier, this is mostly for the business owner. And if you think about it, the business owner really needs to look at how are they going to retire. A lot of businesses have almost all their net worth tied up in their business or qualified plans. So they look at their business as sort of a retirement plan, and that sometimes doesn't work out as well as they think. So they need other ways to save. So, how much is the business worth, blah, blah, blah. Do you have a qualified buyer, so on and so forth. In addition to that, they mostly save in qualified money because their account says you need a deduction, put some money in a SEP or whatever. And so you end up with a lot of qualified plans like this. So the problem with qualified plans, as everybody knows, and I use this slide periodically, but right now we're right here. Tax rates are relatively low compared to how significant they've been in the past. Now, this is the highest marginal tax rate. So we're at approximately 37%. If you count what they call the Obamacare tax, it's actually about 40, but these are just the highest tax brackets. So that kind of makes the argument for tax-free in the future. So moving on from there, how does it work? We saw this slide earlier, but really you have the business puts the premiums, in this case is $50,000 into the policy. The owner, executive, in this case business owner, uses the policy to purchase the life insurance policy. So the following year when the taxes are due, in this case I just assumed it was $15,000. We actually take a loan from the policy to pay off the taxes. That way, this feels sort of like it was a deduction or at least a cash flow neutral, which is, I think, a good talking point. And then finally, the family can get tax-free retirement income or tax-free death benefit. So policy details is just 50-year-old male, crediting rate 6%, 50,000 putting in. I'm comparing this to a qualified plan where we're putting pre-tax 50,000 in. Because you're putting 50,000 in, you have to give up, I'm just assuming 10% to your employees. It's pretty typical. And I'm assuming an admin cost of 1,500. Now this is on a comparison 401k to the life insurance. So got the executive bonus. We call it the premier bonus when you take out these loans. And then I have the qualified plan over here. That's just the first 10 years of accumulation. We stop that after the 10th year, and then we're taking money out for retirement. This goes on till age 100. So from the exec bonus side, we can take out 39,000. From the qualified plan, I'm taking out 26,000 after tax. So you can see that's almost 50% more. I mean, it's a big number. I'm going to go back one slide and just show you there's the 50,000 going in. There's the tax reimbursement, the 15,000. We're starting that in the second year because the reality of it is if you did this today, you wouldn't owe taxes on that $50,000 for another, year basically. So that's kind of how that cash flow works. And so we sort of match up those in offsetting years, if that makes sense. So that's sort of how we do that. And then this goes on to year 11, you have the final tax payment there. So this goes on till age 100. I've got all my premium, all the outflows from the policy. And then the next page is a graph actually from our presentation where we're showing, okay, if tax rates stay the same, your qualified plan, you'd only have 26,000. Taxes go up, you'd have approximately 23,000 of income. And in order to match the insurance, you need to earn a 7.8% rate of return. So pretty straightforward. And then this is just a sort of example of that. Or I'm sorry, this is sort of just a table numerically for that, is what these are. So anyways, what I wanted to share with you is just our sample proposal. So hopefully I can get this to minimize, I think. Let's see here, bear with me for a second. Here we go. So hopefully everybody can see this presentation, but it's a PDF. This is just our sort of presentation that we can put it. Sorry, I'm looking over here because I have another screen over there that I'm sharing this on, but you can see I've got the logo, our logo on here. This can be changed to whatever your company name is, as well as the color scheme. This is the stock photo guide can be changed to the type of person that you're dealing with, demographics wise. And then it sort of starts off with, well, how are you saving for retirement? Then it goes on for the history of the tax rates. So I have that. The Tax Cuts and Jobs Act, just a little blurb about that. I have information about the advantages for the business owner and the executive, and then how it works, which actually you saw this slide earlier. And then the ledger pages, which that was cut straight from there. And then finally the bar graph there. So pretty simple presentation, easy to walk someone through and easy to show the advantages. I look at this as a really good alternative, and I'll close this out, but I look at this as a really good alternative to like telling somebody to do a SEP IRA, or maybe if they are doing a SEP IRA and they have like employees now, this would be a good opportunity for them, and that sort of thing. So this is a really simple, easy to understand strategy. You don't have to do that bonus where we reimburse for taxes. That's just something that we put in here. It makes it work a little bit better because you have the loan spread there and whatnot. So anyways, that's really the main highlights. We'll be following up with everybody, and we can set up meetings to review this with anybody who has any questions. And so be expecting that email. And if you have any questions, you can reach out to my office. My phone number is 972-338-9655. My extension is 102. Try to get me or Brendan. Me and Brendan will be calling to just try to follow up with everybody. I'll stay in for a few minutes. If anybody has any questions, feel free to type those out. And like I said, we'll be following up with everybody.